smart. That's what you're doing. But now, when you change colors here, over on the other side of your life, you got 30,000 in credit card debts. Okay, you got 30K here. You got that line of credit that you took out years ago that's 10K. You got that consolidation loan that you took out to pay off the credit cards the first time you wrapped them up, and that's 20K. Your credit cards are charging you 24.99%. Your line of credit's charging you 6.99. Your consolidation loan's 8.99. You got all these debts. You got a car loan. Your car loan, no big deal. You got a $30,000 car, and that's only 3%. Up here in your 401k, you got 200 grand sitting there. That 200 grand could pay off your credit cards, could pay off your line of credit, could pay off your consolidation loan, could pay off your credit card or your car loan. And what would be the blended return over here? I don't know. Let's say it's 15%. How many of you would be okay making 15% on your 401k? All your hands should go up. You'd probably be ecstatic to make 15% on your 401k. Well, here's how easy it is. If you took your money out of the market, okay, and I'm not telling you to do this, you got to check your CPA. I'm just telling you, just logically think about this. You took enough money out of your 401k to pay all these off. And let's say that $30,000 credit card, you were trying to pay it off, so you're paying $1,000 a month. And then that line of credit, you're trying to pay that off, so you're doing $500 a month. You're trying to pay that consolidation loan off, and they're charging you $700 a month. And then that car loan is $500 a month. How much did I just do? So I got $2,700, $2,700 a month that you're giving away to somebody else. If we just took whatever this balance is, 30, 60, 70, 80, 90, if we took 90,000 from your 401k, which now brings you down to 110,000 here, okay, which you're still contributing to, but we take the 90 grand, we paid all your credit cards off, you just made 15%, and then instead of just saying, okay, I'm done, I got no debt, no. Then what you do is you set up a bill pay to your checking account for the exact same amount you were giving your credit cards, the exact same amount you were giving your line of credit, the exact same amount you were giving that consolidation loan, the exact same amount you were paying for that car, and you write yourself a check. Now you're bringing in $2,700 a month. Folks, you didn't have to work any harder for that money. You didn't have to put in overtime. You didn't have to worry about this whole freaking depression thing. All you did is you just paid off and took back the money you were giving to everybody else, and now some people can retire on $2,700 a month, folks.
Now, just to be clear though, what you were describing there is what some would call bad debt versus good debt. So you wanted to talk about bad before people lose time.
Bad debt. I didn't put your house in there, did I? I'm not saying that's good debt, but it's better debt. I used bad debt. Credit card, you're always losing. Only one win is the credit card company. Line of credit, depends. A home equity line of credit, if you're using that money to make more, like let's say, now your line of credit, you shouldn't pay that off. If you've got that 10K and you're basically getting paid, what was that? No, I'm sorry, 6.99. 6.99% on that 10K is what your line of credit is costing you. But let's say you found a way to take and loan that money out at 12%. That's good debt. You're making more than you're spending. Okay, if you got a house and you got a home equity line of credit, and you take that home equity line out and you buy a rental property, and that rental property is paying you equivalent of 10% return, and your line of credit, your HELOC, is costing you 5%, good debt. This, bad debt. That, if not being used for anything other than buying your lawnmower, remodeling your kitchen, your bathroom, bad debt. Consolidation loan, always bad debt. Car loan? I don't know, does your car appreciate in value or depreciate? Does your car put money in your pocket? Maybe if you drive Uber?
Depreciate.
I'm just, listen, folks, you guys already know the answers. I already told you. You're way smarter than you think.
Let me ask you a question, because I think this is going to come up, because I think, in my challenge group, I try to get people to become proactive, but I'm really afraid that a lot of Americans are really just sitting on the sidelines watching, and they're going to watch their jobs disappear. What about somebody who's really, man, they think the gig's up, they think their boss isn't being honest, they think they're gonna be a bunch of layoffs coming, they just haven't announced it yet, there's whispers in the locker room, like they're starting to hear the whispers. What would you tell them to do? Because they really need that paycheck.
They do, and that's a difficult thing, and that's the thing that a lot of Americans right now are having to deal with. I mean, if you lose your job and your income shuts off, sure, you got unemployment right now, but what happens when that dries up? Then what? Well, I think you really need to start really looking at additional, and I'm not going to get into budgeting, but additional revenue sources. You gotta create a business.
Start a business. I don't care. Find something you love doing. You love baking pies? Bake pies and sell them online. Okay?
I would make it simpler. I would say you need to find something to sell.
Yeah, you do. And not only that, like, you know, if you follow me on Facebook or Instagram, you're seeing this opportunity that I have to make $750 a month. It's not through me, but somebody told me that they needed some help. And I said, hey, I got some people that could do this. And a bunch of your people are already, you know, and it's not for everybody. Not everybody's going to qualify, but if you could do $750 a month, it costs you absolutely nothing. It has zero risk, zero liability. It's going to take about 6 hours of your time. Then shoot me an email. And I'll send you the link. I'll send you the video. It's $750.
Yeah.
You're creative.
I tell people.
I didn't want to announce that here, but that's real. Like,
I tell people in my challenge group, like, I'm like, dude, like, if you are not financially secure, why are you sitting on the couch? You should be cleaning houses. Your husband should be mowing yards on the weekends collecting, like you said, money. Your kids need to be picking up jobs at McDonald's. You got to get the whole family, because I really, really feel that we are in for major.
Oh, listen, I'm trying not to scare your people too much, but I'll tell you what, if you're not thinking the D word, then you're probably not thinking right. I hate to say it, folks, but the history repeats itself. We're in line for a 75-year pattern. Okay, it's a 75-year pattern, not the normal 7 to 10 year pattern. This is the normal 7 to 10 year plus the 75-year pattern, plus just the most crazy chain of events that has ever hit this country. Like, this bull crap that we're in right now, this is just like, we're going to look back at that and I don't even know what we're going to think. I really don't.
Yeah.
I'm scared.
Our car's up. I can't believe it, dude.
Yeah, I mean, I'm scared, but listen, folks, you just got to get smarter about this. You don't need to know all the stuff that I know. Just think about, what does your future look like if you lose most of your money?
Yeah.
And if you can't handle that, then take some action today, not tomorrow. My watch always says now, folks. It says now because that's the only time you can control. You can't control what happened in the future or in the past. And you certainly can't control the future. Only God knows what that's going to look like. So this is it.
Hey, real quick, in the last 30 seconds, you do a monthly training, 3-day weekend workshop, right?
I do.
Tell us about it. They can learn more at drvmoney.com, but can you tell us about it?
Yeah, so once a month we do a training, a 3-day training where you get just me and my mentors and the people that I do work with to teach you all about how money works, teach you things like this. We go over a whole market patterns thing, show you what to do with your money, how to make your money work for you, how to raise money if you want to get money for your business or for real estate. And we show you all sorts of other things, how to fix your credit, how to protect your assets or protect your asses like I like to call it. We do all this in 3 days, and it's dirt cheap. It's $197. Folks, we even give you a shirt now. So we'll give you a shirt if you sign up. So most people are like, $197, but I want that shirt. What does my shirt say? I've never met a dollar I didn't like. So that's the new shirt for this month, and every month we have a new shirt. So hell, $197 for a shirt like this, that might be valuable, but the value you're going to get by coming to the 3-day, I mean, a bunch of your people are
3 days. It's crazy. 3 days
for 3 stinking days.
And it's not just you, though, but you got some other amazing teachers.
Yeah, Kevin Shortell, Chris Rude, we got Brent comes in, 2 Brents come in. Yeah, it's listen, like I put this together so that I can make sure that people get the things that they need for right now. And then you get MSTV too, Money School TV, which is where all the training is. MSTV was designed to give you play-by-play instructions and knowledge and trainings on what to do right now. Not those stupid trainings that were done 3 years ago. No, we're always doing new ones because things change.
Yeah.
You know that. So the next one's going to be in November. Check it out. You put the link up. I mean, the 3-day for $197, you spend more than that on Starbucks and freaking, I don't know, whatever else you spend money on. It's cheap.
Date with Erica is like fucking like $350.
Yeah. No, so I mean,
November the next 3-day weekend. Check it out, drvmoney.com. Chris, you've been amazing, dude. You're always dropping some nuggets. Can you come back next Tuesday? Can we get more people on next Tuesday? All right, guys, next Tuesday night, same time. Mark your calendars. Go ahead, mark your calendars down. And go ahead, I'm going to get out of here. I want you to show that watch again because I love that.
Says now.
How cool is that? The only thing they'll watch is $550.
Yeah. No, so I mean,
Remember the next 3-day weekend. Check it out, drvmoney.com. Chris, you've been amazing, dude. You're always dropping some nuggets. Can you come back next Tuesday? Can we get more people on next Tuesday? All right, guys. Next Tuesday night, same time. Mark your calendars. Go ahead, mark your calendars down, and go ahead. I'm gonna get out of here. I want you to show that watch again because I love that.
says now.
How cool is that? The only thing the watch says is now.
Hey, one other thing too, if any of you, I got something really cool we just did. It's called a quick start guide. So this is going to talk about a lot of the things we just did. It's 23 pages, actually 22. You guys can have this for free. If you guys want that, write this down, write my email. It's Chris@themoneymultiplier. Send me an email and just put in there quick start and I'll send you that for free. It's not a sales piece, it's just an education piece. There's no sale, nothing, just free knowledge. I'm all about giving free knowledge, and if you do that, I'll even put you on our newsletter. We do a newsletter once a month. We send this out, and every month it's got all sorts of fun stuff. Last month was how a penny beats $1 million. This month is even better. So I'm trying to give so much stuff for free, and people are like, why do you give everything away for free? Because a mentor once told me, a mentor you know well, Greg, said, the biggest secret is give your best stuff away for free. And because I do that, it works, folks. Because if you give, you get. That's the nat.
Will the financial big bang trigger a derivatives market meltdown? I'm going to explain this to you in 3 simple, fast steps. Step number 1, we need to demystify LIBOR. What on earth is the LIBOR rate? Before we get into that, let's go over some terminology. This big bang that everybody has been talking about is simply moving the universal rate used for lending. We'll get to that in just a minute. From LIBOR over to something called SOFR, which is SOFR. And that's a rate we're going to be using just domestically. But let's go over what LIBOR is so we can really get straight on what these terms are, so we can understand what this big bang is and how they're going to be transitioning from LIBOR over to this new rate called SOFR, SOFR. And for a definition of LIBOR, to figure out exactly what it is and what it does, let's go right to Investopedia. The London Interbank Offered Rate, or LIBOR, is actually a set of several benchmarks that reflect the average interest rate at which large global banks can borrow from each other. It's the leading indicator used to price loans and other debt instruments. And the key takeaway is this is an interest rate that's derived not from transactions, but just from questioning other banks. So each morning around 7 a.m. Eastern Time, the ICE Benchmark Administration asks a panel of contributor banks to answer the following question. At what rate could you borrow funds were you to do so by asking for and then accepting interbank offers in a reasonable size just prior to 11 a.m. London time? So they quite literally just get a call on the phone, they answer the question, and from those questions, whatever they say, they could say 20% or negative 10%, and they just take their word at face value, and they take an average of that, and that's how they get LIBOR.
Okay, let's get going. I was looking at this, the pattern recognition, and these things are so subjective, very subjective. If we went and what patterns do we just want to see? Okay, I'm going to make it very, very simple. Let's remove all, and then let's just say ascending triangles. Okay. And let's see which stocks would have an ascending triangle. And matter of fact, I think I could do a scan for it much better than I can do that. Where's the clear filters? There we go. because that's the subjectivity in terms of okay, what patterns do we want? Okay, time frame 1 day. We want to do on a daily chart, or we'll go 20 days. Okay, we'll do a 15-minute chart. So what we'll do is we'll go into a 15-minute chart and start looking for patterns. Let's see. Let's go with. Let's get rid of some of these. Let's just go. All we're looking for is ascending triangles. Whichever stock shows you ascending triangles. Then I'll show you how I look at patterns. It's basically the same, but I want to use it in terms of logic, because this could be very subjective in terms of, so what do you think this, pattern should be? Well, it's like what Gammon was talking about in terms of the he was talking about in terms of the London Interbank offered rate. And let's add another filter. Let's only go with high cap stocks. Let's see. We're going to have stocks with that are very, very expensive. So the ask, let's make them. Gosh, let's see. The ask price has to be way up there. Let's just go $70 and above, which isn't really that much, but yeah. So we're just needling it down. Let's go with a big market cap. Add a stock filter. I want something that's huge in terms of market cap. Oh wait, not the ask size. Oh yeah, the ask is what ask size. Okay. I wanted to, let's see, ask is what I want. Not ask to size, the ask. Okay, there we go. So I want it to be something over 70, maybe $80. Just so that way we have, say $80. Oops. Okay. We're going to have a market cap that's huge. Because I only want the stocks that are like in the upper range. And I'm going to go out of those fat tails. Go in that upper range right there. It has damn near all the volume in the world. Let's put a lot of volume in there. I just want something that's traded real well. It has a lot of folks trading it. And we're scanning for these patterns. Again, in the upper range of volume. I want that to be just huge. And we're going to go ahead and do 100 of them. Let's go with 200. Cool. And of course, we're going to see Apple. Let me go with the volume. Because you're more than likely going to see some of these lesser ones. Oh, you know what? Instead of the ask, I want the last price to be up there. Because I want to see the closing price. And I want that to be quite high. Oops, that's backfall. Last price. The last. There we go. I want that price to be kind of high. The markets are closed right now, so we're not really gonna see any. Okay, cool. Okay, cool. Yeah, and then a lot of volume. Now these don't have as much volume, and what I'm gonna do is I'm gonna go by market cap. Let's see. Let's just do the market cap right there. There we go. There's Apple, Amazon, Google, and all that. I'm gonna go with something with the lesser market cap, kind of in the middle of this range of stuff. And let's see. Let's go with John Deere. So we're at a 15-minute. We're looking for ascending triangles on a 15-minute chart of John Deere. So we'll go JD. Or no, that's DE, excuse me. DE. And these are the ascending, and I believe that's what I scanned for. Or was it rising wedges? What did I scan for? Thought it was, yeah, ascending triangles. Okay? For the last 20 days. We're going to go in the last 360 days. Okay. What is INSP? Let's check that out. I'm giving it a whole year. Just to see what their pattern recognition does. To see if we see anything that we can use. And I'm not seeing anything. What was the other one? LSI. You see, I just want to see what their recognition, it says that it would have it, but I don't see it anywhere. Okay, so let's go, instead of 20 days, let's go 60 days. Or 90 days. Okay, we'll go 90. Wonder how we can edit this. Direction, both directions, okay. Pattern length from 10 days to 500. Okay, that's okay. That sounds good. Let's scan and see what we see here. Oh, I guess we're not going to get it in 90 days. So let's go back to 30. Dang. Okay, so 30 days is not giving us 30 days in a 1 hour. Let's go 30 days in a 15 minute. That's why. Okay. Let's go 90 days on a 15 minute. Okay, that's what it was. Okay. But anyways, we had John Deere. Let's try Johnson & Johnson. So we got two stocks we know is DE and J&J. Because I always like to see different stocks. Okay, so this is Johnson & Johnson. They talk about, when you're looking at pattern recognition, I like to look at it and what's the logic behind it. Now, looking at this, of course, we would say, well, this looks like it is, it is a pattern that is, like, I like to extend these just so that way because this is ascending triangles is what they're talking about. And of course, this is, I think I had it on 10 days. 10 days, those 10 days would be the ascending triangle. Okay, because it's pointing up. But the thing is as when it popped out of here, a lot of times folks would say, "Oh, I gotta buy it," and then what did it do? It popped right back in. And it's very subjective. And I like to take subjectivity out of the way I trade, or at least try to take as much as I can out of the way I trade. This one's quite interesting because I think I scanned it for how many days was that? Edit from 10 to 500 days. Okay, the sensitivity, overall signal level, fine tune. I want to fine tune it. Initial trend. Okay, strong. It's like everything is on weak. Breakout strength. Okay. I'm gonna have to really get back in here, but this is really interesting how they have this. Uniformity. Okay, how uniform is it? The clarity, strong clarity. We'll just move these up just for the kicks and giggles. And scan, because I want to show you what happens when you have subjectivity in there. I like to use market logic, so that way I'm using everything. It's not just I'm not just being very subjective into where I think this is. I don't like the I thinks. I like to get something that is like really helps me make a decision. And oh, okay, I see. This just moves all that. Original signal level. Okay, I see. So the original signal is, we'll just fine tune. Oh, never mind. I got that. So let's apply that. And let's just do a scan and see what we got. See if we can needle it down. I guess not. Okay. Interesting. I wanted to see if I could change the strength of this. Let's go. I don't care about that. The initial trend. Let's go to initial strong trend. Okay, fine tune. Let's see. Let's just reset that. But I want to show you the when Anyways, let's just get back to the chart because that's pretty interesting how they like I said, for me it's a little subjective. Now you have this and then you have these two, which is basically I want to look at market logic. They are using good market logic. This point and this point, this point and this point. If we extended this line right here, they are using good market logic. And we did that. There's our triangle. How do we know if it's going to break down or break up? The one that we did before, of course, we would have been blown out out the water because that breakout you would have bought and then the market instantly reversed on you. Okay, so it's like looking at the subjectivity, they have this right here, and then right here, so therefore, when I look at this, I like to have 2 points. The difference between that and here is you have the 2 points, this one and these are literally almost the same distance from each other. They're a little bit, this one's a little longer than this. And I notice when you have that, your subjectivity goes down quite a bit and you're using market logic. Outside of that, like, using, the more and more you extend one, like they extended this one, the more and more you get a lot of ambiguity, and also the later that you actually are in the trade. Like, it would have broken down here, whereas it broke down here first. You have this, where we can, let me see if I could just extend these. I guess I can't. I was looking to see if I could extend those. Okay, yeah, so that's where we are now in time. Now let's go to a 15-minute and let's just see if there's any in the 15-minute. Let's see. Let's edit this. 15-minute, how many days can we get? 360? We can get a whole year? No. See, I think we can get 180 days though. In 15 minutes. Yeah. I wonder if we can get a whole year in 15 minutes. I don't think so. Not in this. Yeah. So we'll go 180 days at 15 minutes. Man, this food I'm cooking is smelling really good. And we're going to look for ascending triangles. Again, it's about market logic. And ascending triangles, normally they, the pattern, like if you read Murphy's book on patterns, I think he's the one that this is his name, John Murphy or something like that. He's like the one that wrote the whole thing on technical patterns. I think Martin Pring had one. It's been years since but these are ascending triangles, which are, ascending triangles are mostly bullish, because you have one that's flat. Is that the ascending? Or is it if they're both pointing up, then if both lines are pointing up, that's usually bearish. If the top line is flat and the bottom line is what's that? Oh, the bottom line is slanted. Then pointing up in the direction, then that's supposed to be bullish. Whereas if both lines are pointing up, it's bearish because it's an absence of momentum going and going toward the market. So these, and I believe, let me just because it's been a while since I strictly looked at chart patterns and traded just chart patterns. But I like the fact that we're looking at market logic, okay. And what I like to do, let me just go in through here. So that way we could get it, we can get Yeah, I'm trying to think. What was the guy's name? Oh man, not Martin Pring. I'm just trying to get something very simple that I'm just looking at something simple that I could actually ascending triangles. It's just because I can show you in terms of how to take subjectivity out of it. And let's see, that's all I care about is how could I take the subjectivity out of what I'm doing and make it a lot easier for me to go ahead and say 9 times out of 10 this thing happens, 2 times out of 10 this thing happens, and I'm not necessarily looking for 1, 2, 3, 4, 5. I'm up here spacing out. I'm not necessarily trying to say it has to do this or it has to do that. So I'm just trying to find some good chart patterns here. Yeah, because you've got the ascending triangles and you have wedges. You've got rising wedges. Let me see if I could find, the ascending triangles. So that way, the ascending triangle, I'm going to read it from Investopedia, is a chart pattern used and is created by price moves that allow horizontal line to be drawn along the swing highs and a rising, so that's the one that's rising. That's the ascending triangle is usually, a bullish type. I think it's usually a bullish signal. Yeah. Yeah, you have the let's see. Let's just double check. Man, it's been a minute since I just strictly did chart patterns. Okay. The ascending triangle is generally considered to be a continuation pattern. Yes, most all these are continuation. Some are reversals. The ascending the it's like a wedge where both lines are pointing up is a bearish, and the logic behind that is just because of the absence of momentum. But it says here, an ascending triangle is generally considered to be a continuation pattern, meaning the pattern is significant if it occurs within an uptrend or downtrend. Once the breakout from the triangle occurs, traders aggressively buy or sell the asset depending on which direction the price broke out. And let's see some of the other ones. But what I want to show you is what I look like in terms of market logic and how I use that to how I use market logic to help me be very more deterministic of not having to deal with, this pattern does that, it has to do that. No, I look at where the buyers and sellers are, and then I use geometry to go ahead, because triangles are geometric, and so are the decisions of buyers and sellers. They're very geometric. So I'm going to go ahead and let me see if I could find. Man, those mushrooms are smelling so damn good. I got to turn those real quick. So anyways, what I like to look at is this is market logic right here. You've got 2 points right here and then 2 points right here. Okay, so you have these 2 points from this side of the square to this side of the square. That's your bottom. And this side of the square to this side of your square is your top. So this point to this point and this point to this point, that's a ascending triangle, because this is more of a continuation. But you see how it broke out here. Most folks would think, hey, it would break up. Actually it continued the direction we're in. So we were going down, it continued down. These are normally bullish, for lack of a better term, bullish. When this is flat and this is rising up, that's usually a bullish indicator in terms of the books. And I'm trying to think if it's Murphy's book that did that. Yeah, like right here, you have this same pattern, but it's a continuation of the bullish trend. But normally that signals bullishness because of the fact that it broke out of where basically this was major resistance and it broke that resistance. Right here you have rising buyers and sellers, and you have like an intense selling pressure right here that's saying you're not going to no one's going to buy over there. And once it buys there, then all the stops are triggered. In theory, just logically. So you've got all this rising action. You had the sellers come into here, and then you have, literally nobody could sell this thing underneath this line right here. Then all of a sudden you got higher momentum where you've got a higher amount of folks that are selling it higher and buying it higher at that point. And once it broke here, then the folks that sold it here are more prone, since these are all triggered out, and there's nothing but buy stops that are triggered right here, that all these sellers are now in trouble. Then the market has a tendency to go and go up, and that's normally the bullishness, because you have this absolute resistance right here, which is more flat. The flatter this is, the more, because it's saying, look, that's major selling pressure. The thing that I like to signify that tells me is there's different things to look at. One, the distance between the points of the buying momentum. Where in relationship to the triangle, and I can't give out too many secrets, but where in the relationship of the triangle, let me just do this because this would be part of the triangle. Where in the relationship of the triangle are those 2 points? These 2 points happened before these. So, these 2 points happened at a little bit after this right here. So that the relationship of where the points are at. Let's see if we have some more here. And as I showed on a video earlier on another channel, I also like to look at the price action within the triangle itself. And then it's a very simple technique. So you got this. And then I like to look at, let's do this again, this point to this point, and this point to this point. And a lot of these help determine not only, because remember, whoever sold here and whoever sold here got knocked out the market right here. They were expecting to break down. Whoever sold here and whoever sold here, and actually, let me activate this. It would actually be like right here. This buyer is what made these sellers literally blow those sellers out the market, with these buyers that came in this higher momentum, and that projected the market to go up, even though it went back into the triangle. And actually, you could even say this, when it broke back in. Oops. When it broke back in, it broke back right here. So you see, not only where these are positioned, if this is first, before that, but also the sizes of, the distance between the distances between the 2 points of buyers and sellers that made this deterministic of a breakout. Again, these are just things to help you make better decisions in markets. This helps make better decisions. These are things I like to look at. I say, how many times did X, Y, Z happen? And what was the result of X, Y, and Z? How serious was the result of X, Y, and Z? Right here, you had a breakout to the downside. And then I say, what was the leading factor? Where were they positioned, the buyers and sellers? And then what's happened with the price action within it? And then there's one little technique, but I'm not going to get into that too much of that. So you have this, and then you have this. Look at where the price action was within the triangle. Of course, it was literally down at the bottom. And actually, yeah, you could even bring this over here, because it did bounce a little bit on these. And then the market goes ahead and establishes a downward breakout. It wasn't a sustainable one, but it definitely broke down. It was definitely tradable. Let me go turn these mushrooms around so that way I can, because they're just smelling too good. Sauteed with wine, with Mabak wine and garlic. Topped with a parsley. Oh. Okay, so let's get back to it. So yes, how they're doing pattern recognition is using market logic, but I don't like to be subjective. I want to needle this down to where I want to know, is it really a triangle first off? Or is it really a chart pattern that folks tell you, okay, this is a chart pattern. I want to know for a fact, is it a chart pattern? Some of these are very subjective because of course you had this one and this one, but then this breakout, or before the breakout, they had to add more and more lines, or more and more points to make that trend line. The trend line started like here at first. And of course they were using aftermarket data. But again, it's just, I don't want to be subjective. I want to, or not too subjective, because all these are subjective because they're like, they're in the eye of the beholder. But you have this right here, of course. This started out as a wedge or an ascending triangle. But what happened? Because of the fact that you had this market, you cannot discount this right here. So all of a sudden it had to change. That had to change. And so your ascending triangle turned into basically either a wedge or a longer term ascending triangle. I also look at how close they are to the apex of the triangle. And again, we're using aftermarket data, but all this data still matters. And that's why they had to draw this. So sometimes, on the strength and the sensitivity of your triangle, that's again puts it in that subjective mode. And I just can't really buy subjectivity in that kind of, because just because this is your initial line right here that went up, they had to, once it went over here, all this market action still isn't, it still means something, even though this bounced back in. It went back in, and, and then they're using another point right here as a point, on that one line right there, which makes sense because that, the market logic is still, the momentum is still there, but it's not like as important, even though you had a really good breakdown. And the thing is again, it just brings, for me, it brings in a little bit too much subjectivity for me to be able to trade. Again, trading is not about being right and knowing this and knowing that. It's just about decisions. Making a decision, sticking to that decision, and how much you're willing to risk to make that decision come to fruition. Now we have this, okay, from here to here. And I also look at how close to the apex that this thing happens. Normally, the closer to the apex, the bigger the move. Okay, normally, because you have all that built up uncertainty of the markets. But I also look at, again, where's the price action at? Where was the majority of the price action that was in there? That tells me, and when I say the majority of the price action, that's where the triangle started, and this is where it started. Oops. Let's do it with a line. This line right here to this line right here. So that literally, that's literally your triangle. Where was the majority of the price action? And in what relationship did the majority of the price action force it? Was the majority of the price action toward the apex? Was it on the top half or the bottom half of the triangle? And when I say half, I always do this because I want to know what are the market participants as they're driving the momentums to the area that they're at. I take the apex of the triangle and I go right to the half mark of the base. Oops, let's do this. I do this. Also, is the triangle pointing up, pointing down, or is it a flat or ascending? Where the top is flat and the bottom is just ascending. So I want to know, where was the majority of the price action? Look at how little bit of price action you had. You had up the top of the price action was here and here. So you have all these sellers right here that were gotten knocked out by these buyers. Once they became sellers again, especially the importance going toward the apex, what is that telling? How many times out of 80 does that happen? Also, the point between this point and this point, again, which is 9 times out of 10 the case, is a lot further toward the apex than the point from here to here. Okay, so so the buying points are closer to the apex than the selling points, and you'll see that more often than not. But those are definitely things you could determine. you can actually use those as a way to make statistics for yourself to say how many times has something happened. Now this right here isn't really, I'm wondering what they're using for this, unless there was like a tick of some kind of data that happened here, because I don't know how they, again, this is something that they use, and this is their pattern, is their pattern indicator basically, or scanner. And again, this looks good. This looks, but here's the kicker. Problem being, this is where they set their, again, the width, like this is so uneven. You have this trend, and that's where this trend started. Of course, it took it back up here, but that's where they determined that. And then you got this entire thing. It's so uneven. You got this tiny little square and this big guy right here. So, how do you know where the market's going to go? Or what's the where the buyers and sellers? And of course, it was after market hours. But that as a pattern is just, it's really too subjective for me to say. And of course, a lot of folks will say, well, look, why not use this and this? That's possible, but you could tell that this was set up by this little trend right here. And that's something that just, for me, I can't really determine. And most of the price action was, if you look right from here to here, most of the price action is at the bottom of the triangle. At the bottom half of the triangle. We do that. Then we do this. And all it is just how much are you going to risk? We'll say that's about the center. To make a decision. So let's get rid of this guy. Let's get rid of the squares. Squares. Most of the price action is in the bottom of this range. See, that's just too, but it was too indecisive because this is where your trend was starting. And you had this entire area right here where, this is where your, this entire area, right from like right here to right here, is how they determined, where the sellers were sitting at. They created that resistance, and just for me, it's too ambiguous. I want to see over and over and over and over. Therefore, when I do it, I could say, oh, okay, I'll make this decision and get into this. I'll get into this pattern, and because this pattern is something that's happened a million times, and the market has done that. But these are the things I look at in terms of trying to make a very good determination. Again, this is not really enough market data. You might have had something up here that created this line right here, but that's too ambiguous. I don't like things that are too ambiguous. And I know why a lot of it is because they're using a lot. Let's see if we can do a better scan and scan for stuff that's even a lot. Now this one right here is a little better. Why? Because we have 2 points here. And I say a little better. I should say a lot better. But see, the thing is, look at how they're determining this. That would be more deterministic of where this market would be. Thus, it'll put you outside, like this breakout right here. A lot of folks could have made money on that breakout. But this right here, this little pattern, people would have lost money right there in that breakout. I want to do the extreme markets, the extremes, so that way I'll know that, one, this is my sellers, and these are my buyers. Who's closest to the finish line? 9 times out of 10, the buyers would be closer to the finish line, on an ascending triangle. But like the one before, we saw that it wasn't. That it was the sellers, and it was very ambiguous. Then I like to look at here, this right here. What in this triangle, in that symmetric triangle, we'll do that. I want to know basically what it is making, by doing this 1,000,000 times over, you could actually be very deterministic in terms of the probabilities this thing will break up or break down. Again, you had more buying action here and just a little bit of selling action here. I think I mixed it up in the last one. Just a little bit of selling action. And of course, our buyers are a lot closer to the, are a lot closer to the apex of the triangle than the sellers, as we saw. And we can even say that the buyers came back in. So this would actually be our buying. And I like to see how many dozens of times stuff like this happens. So the buyers and the sellers are almost equally in terms of length. Sellers might be just a little bit more. Let's double check. See who's more. Yeah. So the sellers have a little bit more. And then when it went to the buyers, to the sellers, because this is a selling action. Look at all this price action on buying. You had all this price action on buying after the selling. I want to know, just how serious it is. Well, look at the positions, not only how close they are to the apex, but also how close they are in terms of, like, where is this selling, or where is this selling action positioned close to the apex? How far is this buying action positioned close to the apex? Right here is where you had your breakouts. So, but the determining factor of these triangles was this, and this. So I want to know, where the squares are at. Those are what determined what this triangle should be. Where is the selling action? Because the sellers came here, remember the initial selling action happened, buyers came in, then you had a gang load of selling action to create that second seller, buyers came in. And buyers just came in with a vengeance. That initial selling action in position to the apex and the beginning of the triangle, where are they at? Where are they located? And the relationship to the selling, what caused the selling action. This is what caused the selling action. This is the selling price action. This is the apex. Where is the selling action in relationship? It's kind of right in between. This is the beginning of the buying, and of course, this would be the end of the buying. Where is the selling action from the beginning to the end of the buying? It's a little bit more toward the end. This selling action, I should say, about the middle. I'd say about the middle. And the selling action ended. Where did it end in relationship to the buying action that came in and created this? If it was something like this and the selling action end, and again, it would you would have a lot longer triangle or something. That's also a determining factor. If this was your selling action, what initiated your sellers, and the selling action was right here, and it was just nothing but buyers going up, that'll also make a deterministic of how far the breakout will go, how high it'll go, and it's almost always the case because market logic. It just doesn't stop because there's a different pattern. It's just these are the things that tell you, oh, this thing's about to break up or break down, and then I can go ahead and ride the trend. I can ride it until the cows come in. You could literally, let's look at this pattern. I know we did that one. We did that one earlier. Let's go back to this one. Yeah, this is another hard one. You had this. Because when they do these, and this is the one I had earlier. See, again, that right there we could use, but there must have been market action elsewhere for them. Again, I'm like, where did they get this? And I guess it was market action either here or here, which was, market action here. This is what initiated that right there initiated, and then it reinitiated right here, and that's where they got this line from here to here and onwards. This first one right here is this triangle right here. That tiny little action that they had is this right here. There's your buying action. Look at your selling action. This is toward the end of the sellers. This is what in relationship to the apex. This is even though this is within the sellers are still, the selling action is still closer within the apex of the triangle. And the price action, most of the price action is at the bottom. The only real price action that was at the top was at the initial. And then the majority of the price action was at the bottom of the triangle, both triangles. So it gives you a really good determining factor as to where markets are more than likely going to break out. By just doing this, you put this over here, get your center line. And then look at the price action. At the initial stage, and then it just stayed in the bottom half. So this gave the initial stage, there's more price action underneath here than there is up here. But again, you would have had, this was tradable. It was definitely a dominant breakout, because if you see the price action, it was definitely dominant. Of course, it was a fake out, and therefore it turned into a wedge, but that's a whole different thing. You would use the opposite side of this to go ahead and find out your length of the length of how long the trend is going to be, and I'll do that in a different, or how long the breakout will be before it breaks back, and I'll do a whole separate thing on that, because for every action is an equal and opposite reaction, as ancient Kemet said, as above so below, as ancient Kenya said. And if you look at if you look at both sides of the equation, it'll actually tell you how far that it's almost like looking at a MACD, or one of those indicators, but looking at it in a not looking at the indicator, but looking at the background. And I did that with divergence to teach a simple way of a really skillful way of divergence. This is one we did before. The one we did before. We did that. This is what initiated it. These are our selling initiators or buying initiators. Where's all the price action? Where's the price action in relationship to the apex? Where are the selling and buying initiators in relationship to the apex? What is the selling and buying initiations? This is the selling initiators, buying initiators. Look at the fact that the selling initiators are so far away from the buying, where the last buying initiator was. Look at, in relationship with the price action. Where is the price action in there? Who's in control, buyers or sellers, within the triangle? I'm just looking as if you're seeing on the floor, and then you're just seeing where the momentum of the floor. Basically, I'm turning floor trading into a technical analysis. Who's initiating the buying? How much of the action it is, and how far, when did this action, how close is that last buying action to the apex? Of course, you've got more selling price action than buying price action, but you've also got the buying price action is so close to the apex, and the last of the selling initiation happened so far before this last buying initiation happened. If you look at the momentum, or again, that's a momentum, because all these trend lines are is momentum. What do they call those in physics? Oh man, it's going to drive me crazy. It's not vertices. Hold on, because I got to find out. Oh man, my screen ain't sharing. Oh, I hope a lot of this got on there. And maybe if it didn't, it wasn't meant. Let's see. Let's go back. Okay. Okay, there we go. So, here are the selling initiators up here, those 2 points. Buying initiators are those 2 points. Most of the price action definitely happened in the selling action, where in other words, there was a lot of interest. Wherever these sellers were trying to sell, there was so much interest in the top half of that apex, momentum-wise. The bottom half of that, there was, it was just this initial buying, then it went and a massive initial buying, then you had selling that was getting compressed. Look at the initial sellers and how far they were back into the initial buying, because these are the initial buyers that made this trend line. Also look at the fact that how close they are to the apex, because the apex, that'll tell you a lot. And then when this last initial buying came in, and the sellers, look at how close they were to the apex, how far these sellers are from the apex, how close these buyers are to the apex. And I'm talking the initial sellers, where those points are at. What happens? Market breaks up. Little things like that, you could just be very deterministic on how markets are going to trade. And it makes it so much easier. I'll get into how you could tell how far it's going to go in a later broadcast.